Hey everybody, and welcome back to H Invests. My goal with this channel for 2022 is to make my videos more concise, but keep them as informative as they always have been. I hope you guys like the new style. Today we're looking at Tractor Supply, right? They've had a sterling recent performance, up 132% from their pre-pandemic level, which is absolutely crazy. We've also seen incredibly fast growth. So usually they would trade in the kind of high single digits of turnover and EBITDA. Last year, 27% turnover growth and about 35-36% EBITDA growth. But obviously this has come at lofty multiples, right? You've seen the share price increase. They're at an all-time high of price to turnover, an all-time high of EV to EBITDA, and almost an all-time high of PE as well, currently trading at about 33.5 times earnings. Is Tractor Supply still a good deal with this new impressive fast growth it's taken on? Or are the shares now looking overvalued after the massive rally, and is it time to sell? That's what we're going to find out today. I hope you guys enjoyed the video. So who are Tractor Supply? Well, they have these kind of farm retail stores all over the US in 49 states out of 50. They also operate a pets business called PetSense and Dells, which is another farm supply business. They have these large retail outlets in rural areas, obviously for rural country customers, and they've got a fast growing e-commerce segment. And actually, all the diagrams you can see below, they are from the website. So they've got livestock, pets, farm, like these classic farm things. But they've also got a lot of luxury items as well. They're a very high-end retailer. They've got really nice home goods, heating supplies, like, you know, really cool fancy toys, this kind of stuff. So that's who Tractor Supply are. This is their e-commerce website. I went on to their e-commerce website and I felt a warm rush. There was a lot of effort put into it. They had some beautiful products on there, and I think they've done a very, very good job. And that is certainly a significant contributor to their growth in the recent years. So why has this growth happened fundamentally? What has changed to go from 5 to 7% turnover growth to over 25% turnover growth in 1 year? In a pandemic where, you know, for some of it in 2020, their retail stores were shut, right, in many states. Basically, the pandemic has catalyzed, you know, work from home, and that's caused a couple of things. We've seen migration from urban to rural areas, right, as people are like, okay, I'm paying $5,000 a month for this box in the city that I'm living in, but, you know, this farm out in the middle of nowhere also costs $5,000. And then making that shift as their company is not so strict about actual face time in the office. This has led these people with much more disposable income, but also much more disposable time, or at least flexibility of time. And people are really enjoying the country life. So yeah, there's a couple of things to say. Is that there's been a high velocity of people moving home. And also, when people are sitting in their home for a long period of time, they're constantly thinking, oh, this piece of furniture needs replacing, this, that, and the other, you know what I mean? And they'll do this online shopping. That's exactly why places like Home Depot have done so well. And also there's been an increase in pets. This has been a long-term trend. We've seen more and more people buying pets over the last few years. We haven't got the 2021 stats out yet, but I am predicting that there's going to be an even more significant increase in how many people are purchasing pets. Because it's a lovely thing to have at home. If people are spending more time at home and their work is more flexible, then people actually have that capacity to look after pets. But pets live for a very long time. So if you're someone like Tractor Supply that has a massive pet retailer, PetSense, right, then you can do very, very well out of this trend. And as I said, they've got a load of high-end furniture, which is what people moving out of the country are going to be buying. And this is a big component to why they've done so well last year and why they're projected for such fast turnover growth next year as well. So, do Tractor Supply have an economic moat? I've got a few things to say here. Well, firstly, the brand. When I went on their e-commerce, it gave me a really, really positive customer experience. They've got some gorgeous products out there. They've built up a really good brand for this high-end rural retail. I think as well, because they sell these like high-end, high-ticket items, you know, they sell a lot of motorized vehicles, high-end furniture, high-end clothing and shoes. It's got a lot of protection from Amazon, right? Because they're not just buying these, they're not just selling these random generic products, these cheap products that people just want instantly. Tractor Supply is all about this browsing experience for high end, going to the shop and testing the product. So they have got some protection from Amazon and other massive e-commerce retailers, which I think is really, really good. Of course, they're the largest farm retailer in the US, which gives it some scale advantage. They can negotiate lower per unit costs on items because they are buying in bulk on the wholesale side. Delivery, if they're delivering a lot of items all to the same location, they can get a lower per unit cost on delivery. So that always helps to be the largest in your space. And of course, retail, classic low switching cost industry. But I think Tractor Supply, they have managed to establish some switching costs, which is great. You go onto their website and they have points, point schemes where you build up points and you get some stuff for free. They've also got gift vouchers. I would expect to see this from any well-managed retail company. I would be disappointed if I didn't. And whilst it doesn't establish high switching costs, because at the end of the day, anybody on a budget can drive a few miles down the road and go to the budget version of what they're looking for, right? It does give some element of having high customer retention rates, which I think is really, really good. On the other hand, what about the risks? Well, first thing to note is when I looked at how Tractor Supply did in the last recession, they actually did very, very well. You can see the revenue here. We got 2.3, 2.7, 3, 3.2, a bit of a slow in 2008, 2009, but they're still increasing their revenue, which is great. And also, pandemic, massive recession, retail was closed. We've seen a lot of retail massively adversely impacted by the pandemic. And on Tractor Supply, we had 23% year-on-year revenue growth, which is crazy. And there's been a lot of suggestion that this is at least in part to do with its affluent customer base. They haven't been affected so much by the COVID headwinds, where a lot of people who were losing their jobs were in kind of the lower end service sectors. So that is one positive, that it doesn't look too bad on a generic recession. I put the point on purchasing credit in decline just to kind of highlight the situation we're at here with rock bottom rates. I think if rates go up, obviously that can make a very sensitive system, but I'm just thinking if Tractor Supply is a high-end retailer and we've seen such an expansion of credit, so many people buying on credit, and if we see a tightening of that, if rates go up, that could be a big headwind as well. But I don't know exactly how much of this is just COVID related because people are getting lower credit scores and there's more decline. But what I'm trying to say is if we see a cutback in how much people are leveraged and how much people feel comfortable spending, particularly in that high end, particularly in that high income bracket, then that certainly will be a headwind for Tractor Supply. But probably a bigger one for its customer base is, if you kind of see these workers, earning between 100,000 and 300,000 that have moved out to the suburbs and bought these nicer farms, that could be a big issue because the vast majority of Tractor Supply's customer base are people that kind of, they're doing farming as a hobby. They're doing farming part-time. They're involved in the rural lifestyle. It's not so much your bread and butter, working 80 hours a week farmers that need, they're doing it purely from a business standpoint. Most of Tractor Supply's customers are actually leisure. So if these people, there's a demand to go back to the city, office culture comes back to a large degree, and we see big migration to urban areas. As I mentioned, those 2021 stats aren't out yet. That could be a big headwind for Tractor Supply. And then the last one I've got, very generic one, but at the end of the day, there are low barriers to entry in e-commerce. So if we do see a big recession, we're gonna see, people shifting down the price spectrum. And because Tractor Supply is high end, that people will cut back on purchasing from there if they want to maintain a country lifestyle, but at a lower cost. Right, so what about the valuation? I mentioned that the valuations were quite lofty and those multiples might have scared, some traditional value investors, and it scared my DCF models as well. So what have we got here? We've got turnover growth, which as you can see was, again, high single digit, as I mentioned. Then we've got the 27%. Analysts are forecasting massive turnover growth as well in 2021, and then a slump back to even slightly lower than what they were growing pre-COVID. And the free cash flow doesn't tail off quite as quickly. We've seen this artificial big spike and then the free cash flow going down, which is quite unusual. We usually see turnover and then free cash flow going the other way around. and then we see a slow decline. I've put in 10%. So this is a 5-year DCF. I've put in 10% for the last 2 years, highlighting that there is some slowage here, and pre-pandemic, average free cash flow growth, excluding that COVID catalyst, was 11.85%. So to be slightly conservative, I've put in 10%. If you average these free cash flow numbers, even excluded COVID, it comes out a little bit higher. That's just because you've got these really high numbers and the low numbers aren't as extreme. But if you do the compounded average growth rate, you'll get about 12%. So I've put in 10%, 5-year DCF, because that's very similar to the discount rate of 7.5. We'll end it at 5 years, put in a 2.5% terminal growth rate, and we're getting $127 a share, which gives us 45% downside on the current share price. So it doesn't look very good from a DCF perspective at all. Looking very, very overvalued. That's a conservative discount rate as well. 7.5% is quite low. As I mentioned, Tractor Supply isn't the highest risk business at all, but that discount rate is conservative and the valuation from a DCF standpoint does not look good. What about EPS and forward PE? Well, again, we see a similar story. Earnings per share growing kind of high single digit. We've got this massive growth here as the country bumpkin lifestyle is increasing. And then we're seeing a bit of slowage again. In terms of the PE, you know, we've got pretty much the highest PE we've ever seen from Tractor Supply. So we've got PE 23, 22, 19, 20, and then all the way up to 33.6. So the risk here is, if we don't see that high PE going forward, we're going to see overvaluation. So what this valuation is doing is it's multiplying these forecasted earnings per share at discount rates by a PE of about 24, and when you average those out, you're getting an average valuation of $180. If we go to the next slide, we can see how it looks at different growth rates at different PEs. Bearing in mind that the discount rate on this has a much lower weighting. The big weighting on this kind of valuation model is EPS growth and valuations. So these are all at 8% discount rate, which is slightly more conservative than what our DCF came out as, but I don't think Tractor Supply is the riskiest company in the world, so it doesn't need to be a mega high discount rate. But we're seeing, you know, at 10% growth, which is roughly what they grew at in the past and what analysts are forecasting going forward, is looking overvalued. At 15%, it's still looking overvalued at a 22, 25 PE. So in order for this to be undervalued as an investor, you'd have to be comfortable at the assumption that we're going to be at a 35 PE, which is higher than they've ever been. And in order to warrant that, you'd have to say, okay, this fast growth is going to be maintained. But when we looked at the earnings per share, just here again, you can see this earnings per share growth is forecasted to slow from the analysts. So that is a big risk. You know, you either have to say, oh, I'm comfortable with 20% growth or a 35 PE. So on the earnings per share valuation, Tractor Supply is also looking overvalued by quite a significant margin. But here is a little bit of good news, is that the analysts are looking conservative. So here's the surprise percentage. So this is the average analyst forecast over the past 8 quarters. We're comparing that to what Tractor Supply actually did, and you can see that Tractor Supply, they've beaten it over the last 7 quarters. You know, 8 quarters ago they were pretty much flat, but there's some quite significant beats here. You know, nearly 20% here, nearly 60% here, nearly 20% last quarter. So that DCF and that EPS that we built is probably quite conservative, because it looks like the analysts are being conservative. So that does give us a little bit more promise with regards to Tractor Supply, that the margin of safety of overvaluation might not be quite as high if the analysts are being so conservative on this stock. Also, if we look at the technicals, I mentioned this at the start of the video, but we've seen a massive boom from Tractor Supply, up 132% from the pre-pandemic levels in February 2020. If we have a look at a 3-month time frame, you can see the stock has definitely been an uptrend. It's been making these higher highs and these lower and these higher lows, which is great, reaching new all-time highs, bouncing back a little bit, but not quite as low as where it bounced before, then going back up. Again, not bouncing as low as it did before, back up, not quite as low as it did before, but recently we have seen quite a sharp sell-off which has been in line with what the general Nasdaq and the S&P has been doing. We did see a bit of a rebound, but we're at a really interesting level because this rebound came with low volume after having very high volume when this sold off. You can see the high sold off volume here, lower volume on the rebounds, and we're kind of at this almost all-time high level where it's just outside of that channel. If it can get back into that channel, we might be okay. But if the stock falls from here and it struggles to cross this resistance line with this increased volatility, it's not looking as smooth sailing as it did in the past few months where you were kind of bouncing in this very narrow channel. So on a technical standpoint, I think we're really at a key level, and it's going to be very important to watch what the share price does in the next few days to determine whether it can get back into this channel and make all new time highs, or whether in fact it creates some kind of a double top pattern and then falls back down. Right, so in conclusion, am I buying Tractor Supply? You might have guessed it, it's a no from me this time. I will say though, I did go into this being relatively bearish on the stock because I did the valuation first. I saw those, I saw that high premium you were paying for the shares, and I thought, wow, like this could even be something that I put a put option on. But then I looked at the business and I kind of fell in love with the business. I was kind of in this weird position where I love the business just at the wrong price. So yeah, in summary, it's a sterling business, a very strong performance in recent quarters, beating earnings. The moat is narrow, you know, it's okay. They do have a very strong brand from what I've seen. They are the largest in their space, so that gives you scale advantage. Very narrow switching costs, you know, but Tractor Supply being in the retail space, I don't think they're ever going to be somebody to get the widest economic moat in the world, but they do definitely have one. The valuation is much too expensive for me to consider buying at the moment, given my value investing roots, because the stock is priced for double-digit growth, whilst the analysts are forecasting high single-digit growth going forward. Although the analysts are being conservative, so you know, if you're happy paying a bit of premium, that might not mean it is as overvalued as what those models suggest. And we're at a key point for the technicals. If it doesn't get past where it was before we had that big slump in early December, the technicals could look a bit bearish with a double top and Tractor Supply falling outside of that channel. That is basically it from me. I am not going to buy Tractor Supply. I am not going to sell Tractor Supply. I was considering putting a put option on it, but I will only consider that if we keep seeing a sustained share price. I just want a little bit more of A, a wider margin of safety, or B, some very bearish technicals. You know, I don't really want to be putting put options on at all-time highs when the momentum's being quite positive, but that's recently changed. So if we do see more volatility, which is obviously good for options, and you know that momentum turns a bit more negative, I will certainly consider it. I hope you guys enjoyed the video. I wish you all a very, very happy new year, and I'll see you next time. Goodbye.